Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 81 on September 28, 2019. I'm your host, Eric. And in this week's show, we will cover trades from last week on Whiting Petroleum, Uber, and Pinterest. And we discuss three new trades on PG&E, ArcelorMittal, and Bausch Health Company. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can reach me at eric@theweeklyoption.com. That's ERIC at theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the U.S. equity market had another week of slightly lower closes. The Dow Jones Industrial Average dropped 114 points week over week, ending at 26,820 points. The S&P 500 index closed 30 points lower, finishing the week at 2,961 points. Now, this is the part of the show where we get into the topic of the week. The topic of the week is sponsored by the Option Studio. If you want to learn to trade options without any calculus and confusing language, visit the website to learn more about the online course. Visit www.theoptionstudio.com for more information. Now, the topic of the week this week is the importance of finding a strategy that works for you. And I was having a conversation with some guys a few days ago, and it's amazing to me how many people have tried option trading at different points, and more often than not, there are either gaps in their understanding of options and option risk, or they decide to pursue a strategy that just doesn't fit with them. So I wanted to give a couple of thoughts, or give a couple of areas that you should consider when looking at strategies for your own personality and time allotment. So the first one has to do with active involvement. Now, how often are you able to get online and look at options? So if you trade some of the more volatile, the higher volatility spreads like straddles and specifically straddles, strangles, if you're doing ratios that are closer to the money, if you're doing some of those strategies that require a lot more active involvement, but you actually have a 9 to 5, or let's be honest, more like an 8 to 8, that you work Monday through Friday, so you're working during market hours and can't constantly be clicking over, you shouldn't choose a strategy that requires a lot of involvement. I know guys who are doctors and lawyers and are very active and busy during the day, and they decide to do high frequency, essentially styles that are high frequency trading or day trading even of options, and it just doesn't work out because they don't have the time to allocate to their option strategy as they continue to be professionals earning an income that allows them to trade. So at your level of involvement is one of them. Second thing I wanted to point out is the idea of dynamic hedging. So most option books have this concept called delta, right? And delta also has gamma. And the thought is that you will be dynamically hedging your position to make sure that it constantly is staying delta neutral, so that you really are just trading the volatility of the option, not the actual price movement of the underlying index. The other part of that dynamic hedging, so there are two aspects that are challenging here. With dynamic hedging, you need to be able to watch the market constantly throughout the day, or actually at least a few times a day, so that you pick the right points to hedge your position. The other thing is the amount of capital. How much capital do you have to allocate towards options? If you are like many people and you're opening up an options account for less than $50,000, chances are you don't have the money to really take on a strategy that's going to require a significant amount of stock trading. And if you do that, it will also limit the types of the size of companies that you can trade because you're going to be worried about being able to afford the stock. Next part that I like to focus on, and this actually should have been number one, is your risk tolerance. How much can you handle? Not how much winnings or whatever, but what's the size of the loss? What would break you, right? You need to understand you and know you better than anyone else because the market is going to be a reflection. The market is like a mirror. It holds up all your positive qualities, and it's also going to allow you to see. It's going to reflect your negative qualities. So your risk tolerance is very important, and choosing strategies that don't go beyond your risk tolerance will allow you to sleep at night. So if you can't imagine losing more than you put in, maybe buying spreads is for you, or buying options outright. If you can handle a little bit more risk, then you have all sorts of selling opportunities as well, or you get to take advantage of both sides. But your risk tolerance is not a small thing. Don't underestimate that. Next, of course, and I hinted to it earlier, is the size of your capital. Some trading strategies are not going to be available for people with small accounts. You might not be able to sell naked call options in your account. You might not be able to sell naked puts above a certain value based on the size of your trading account. So definitely take that into account when you're creating or choosing a strategy to really hone in on. And then the last one that I'm going to point out is your understanding of options and your experience level for more complex trades. So there are some amazing strategies out there. Some of them are really simple and they make a lot of money. Some of them are super complex and ideally make money. Either way, you're going to need to understand options at a professional level to pursue some of them. And if you're not there, if you're not ready, take the time to just slow down, paper trade a bit, really get to understand why some trades make money and why some don't, and what you do in either case. So just increase your understanding of knowledge of options, and that will open up more strategies, because honestly, you don't need 20 strategies to make good money trading options. Really, you just need one. If you have one good strategy that you understand how to use, how to leverage, and win, you're going to make a killing in the market. I've seen it time and time again. So that's it for the topic of the week. Let's dive into the review of last week's trades. And this was definitely not my best week of trading, but the market did some interesting things this week, and you're going to hear it in my trades. All right, first off, we have the covered call on Whiting Petroleum, symbol WLL, Whiskey Lima Lima. At the time, the stock was trading for $9.63, and I looked at buying that stock and selling the October 10 call at 74 cents, creating a maximum possible return of 11.5% in 4 weeks. Well, Whiting Petroleum stock fell $1.68 this week, finishing the week at $7.95 per share. The October 10 call option we sold at 74 cents is now worth 22 cents, so that's a gain of 52 cents, but it still means that we lost $1.16 net on this trade. Now, I would absolutely buy in that October 10 call, locking in the 52 cent gain, and then sell the October 8 call at 78 cents. Essentially, you're rolling the strike from 10 down to 8. This will also lower the net loss on the trade to about 38 cents. So that's significantly better than the current loss of $1.16 if we do nothing. So my goal is always to win, but if I happen to lose, I want to use my understanding of and knowledge of options to mitigate those losses. So our second trade from last week was a credit spread on Uber Technologies, symbol UBER. Uniform Bravo Echo Romeo. At the time, the stock was trading for $32.60, and I looked at selling that October 33-34 call spread at 35 cents, which can create a maximum possible loss of 65 cents. Now, shares of Uber fell $2.31 this week, ending the week at $30.29. The out of the money call spread we sold is even farther out of the money now. So at this point, you can close it and lock in a profit of 17 cents, or just stay in it and try and capture the maximum profit of 35 cents from the sell of the spread. And you're going to most likely need to hold it through expiration another 4 weeks in order to do that. I would lean more towards holding this trade a little while longer. You don't have to hold it all the way to expiration, but if you hold it a little longer and Uber shares stay down here where they are, this spread's going to continue to depreciate, which is just going to mean your profit is going to keep increasing. And then our final trade from last week was a debit spread on Pinterest, symbol PINS, Papa India November Sierra. The stock at the time was trading for $30.22, and I bought the October 29-30 call spread, paying 65 cents, which creates a maximum gain of 35 cents or 53% return in 5 weeks or 4 weeks. Now, Pinterest shares fell $3.72 this week, closing at $26.50. The in-the-money call spread we bought is now unfortunately out of the money, and the spread can be sold for about 10 cents, locking in a loss of 55 cents. Unfortunately, the other spreads are priced in a way that doesn't really allow us to any other opportunities. So I would normally love to sell a call spread and a put spread, create an iron condor this month to create a nice profit range. But the spreads on the put side are even worse than the spreads on the call side. So I'm not going to be able to do that. So for now, Pinterest will need to remain a loss. This trade's going to basically be a loss in your portfolio. You can always wait a few days and see what the market gives you, because prices are constantly changing, and these option prices sometimes at the end of the week are a little screwy as well, mostly because of mark-to-market stuff that happens on the trading floor. Now, your only risk at this point is 10 cents per spread, right? You've already lost the 55, so there's only 10 cents left. And there's a good chance you're going to lose it, but there is still a chance that you have that the market will come back this way, and that you will in fact finish this as a winner. So sometimes you have to eat a loss, and a Pinterest this Pinterest trade might be one of those times. But either way, I'd say time is still on your side. So wait a day or two, see what's going on in the market, and then you can decide how you plan to react to it. Now, this week, there are some episodes, sometimes there are episodes that I create on this show that are full of trades that I can't wait to execute on. Then sometimes there are episodes where the podcast is certainly more theoretical, and consider this to be in the latter group. I wanted to point out some of the trades that I see in the market, but there are reasons why in some of these trades I'm not really all that excited about it, not excited enough to actually execute them. So we'll start off with the covered call on PG&E Corporation, symbol PCG, Papa Charlie Golf. The stock ended the week at $10.12 per share. I'm looking at buying that stock and concurrently selling the October 10.5 call at $1. This creates a possible return, a maximum return of 13.64% in 3 weeks. So you enter this trade by buying PCG stock for $10.12 and concurrently selling the October 10.5 call at $1. This trade makes the most money if stock prices finish above $10.50 per share. Break-even price is $9.12. Our second trade on the week is a credit spread on ArcelorMittal, symbol MT, Mike Tango. Stock ended the week at $14.16. I'm looking at selling that October 14.5-15 call spread at 16 cents, which can create a maximum loss of 34 cents per spread. You enter this trade by selling the October 14.5 call at 49 cents and buying the October 15 call for 33 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices finish below $14.50 per share. Break-even price is $14.66. And then our final new trade for the week is a debit spread on Bausch Health Company, symbol BHC, Bravo Hotel Charlie. Stock ended the week at $21.70 per share. I'm looking at buying the October 22 half 22 put spread for 33 cents, which can create a maximum gain of 17 cents or 51% return in 3 weeks. Now you enter this trade by buying the October 22 half put for $1.19 and selling the October 22 put at 86 cents. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices finish below $22 per share. The break-even price is $22.17. And that's it for this week's show. Hope you guys have an amazing weekend. Get some rest, a little relaxation. And I hope you come back to the markets on Monday fresh and ready to go. Again, if you have any trades you'd like to discuss with me or anything you hear on the show, feel free to reach out to me. My email address is eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. Thanks so much for listening. Happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.